Welcome to Billy Wilder Theater. I'm Claudia Besser. I'm the Director of Public Programs and Education here at the Hammer Museum. I'm very pleased to introduce tonight's program, The New Deal, How We Can Recover the U.S. Economy. The Hammer Forum is a series of public discussions about current social and political issues, and it's made possible with the generous support of Andy and Branya Galef. Tonight's distinguished guest is Dr. James Galbraith, and our moderator is Ian Masters. Ian is a BBC-trained broadcast journalist who covered national security affairs, or still is covering national security affairs, for over 25 years on public radio. He's the host of Background Briefing and Live from the Left Coast, which can be heard on KPFK from 11 a.m. to 1 p.m. on Sundays. Ian has been a senior fellow at UCLA's Center for Strategic and International Affairs and the UCLA Center for International Relations, and was a consultant to the Center for National Security Studies at Los Alamos Laboratory in New Mexico. So please join me in welcoming Ian Masters.
Thank you, Claudia. And thank you all, the downsized, outsourced, overcharged, undercompensated, and recently fleeced for coming. Let me begin with historical bookends. It appears that Enron began the Bush years, and Morgan Stanley, Goldman Sachs, JP Morgan, and AIG ended them. And in between, according to an expose last January by CBS's 60 Minutes, last summer's huge spike in oil prices, up to $147 a barrel, was run up by speculation from these same big Wall Street investment banks and hedge funds. While they profited, so did Putin, Chavez, Ahmadinejad, but the personal and national security of the American people lost out big time. Yet, like a zombie president, George W. Bush lives on, or at least his economic policies do. 10 Democrats and all 41 Republicans in the United States Senate recently voted to cut the estate taxes of America's wealthiest families, while lowering the top tax rate for the super-rich from 45% to 35%. In co-sponsoring this friend of the oligarch bill, Senator Blanche Lincoln, a Democrat of Arkansas, exhibited brazen fealty to her constituents, the mega-rich Walton heirs, at a time when a massive transfer of wealth from the poor and middle class to the rich continues as beleaguered taxpayers bail out the biggest bankers on Wall Street. I guess the senator counted on a clueless public and a supine press not to notice, even as pundits are telling us about a populist rage welling up in the heartland. To be fair, most politicians in Washington represent money, not people, and when they retire or are voted out, they can trade their public service for private gain. Many become lobbyists for the same rich and powerful interests who supported their careers. Given this is a system we have, and it is run by money for the benefit of those with money, we must accept we are governed by a democracy today, a rule of money and property, in essence, a democracy fronting for an oligarchy. Since Diogenes would have a hard time finding anyone on Capitol Hill who was not grubbing for money, although there are a few, and there used to be many who put people before money, the issue therefore becomes, can we elect a better oligarchy? The oligarchy we have clearly needs to be replaced by a less reckless and more patriotic one. How could a few thousand people, including a few Bernie Madoffs, get so rich while the poor and middle class haven't had a raise in 30 years? But then, to add insult to injury, the overcompensated turn around and wreck the economy, only to be bailed out by the only suckers left paying taxes. Meanwhile, most small, medium, and large businesses in America made money the old-fashioned way, and they are taking a hit along with the rest of us. But the few big players on Wall Street who took down the global economy, incredibly, are still in control and gouging us, while they hold a gun to our heads, claiming they are too big to fail. Since criticism of our ruling class usually provokes howls of class warfare, even though George W. Bush effectively made us all POWs in a class war the rich won handily, we remain in desperate need of more responsible and patriotic oligarchs. Since we can't hire or fire them, a place to start would be to revive what was done back in the 1930s, to figure out how we got into the Great Depression, a Pecora-style investigation. Name and shame them. So I urge you all to call your senators and congressmen, interrupt their fundraisers, and demand they inform the public who was responsible for the great American bank robbery, and insist that they restore laws that were passed after the Pecora investigation to prevent a reckless few from again impoverishing the maxed out many. Tonight, to address these issues and discuss a New Deal, we are privileged to have Dr. James Galbraith, who will speak for about 15 minutes. Then we'll have a discussion before extensive Q&A from you, the audience. Dr. James Galbraith teaches economics at the LBJ School at the University of Texas in Austin, at which he is also the director of the Inequality Project. Dr. Galbraith serves as the chair of the Board of Economists for Peace and Security and writes a column called Econoclast for Mother Jones, and occasional commentary for other publications, including the Texas Observer, the American Prospect, and The Nation. His new book is Predator State: How Conservatives Abandon the Free Market and Why Liberals Should Too. Ladies and gentlemen, Dr. James Galbraith.
Ian, thank you very much, and it's a great pleasure and a privilege to be here tonight. That was a fire-breathing introduction, and I hope you will forgive me if I don't follow through with an entirely fire-breathing speech. I'm going to give you, in the very few minutes that I have, rather an assessment of where I think we are, what, to the extent that we can know, is likely to happen next, what the major problems are, and what we should be doing that we are not doing. Something about the sins of omission and something about the sins of commission. On the airplane here, I worked a bit on a new preface for a book that is now about 55 years old and about to come into a new edition. My father's bestseller, The Great Crash, 1929. And I came across this sentence toward the end of it. He wrote, "One of the pregnant lessons of that year will by now be plain. It is that very specific and personal misfortune awaits those who presume to believe that the future is revealed to them." It's a lesson I take to heart, but the fact is we're all concerned with what is about to happen. Are we on the brink of a new disaster, or are we seeing the shoots of green revealed to us by senior advisors who are perhaps thinking of their speaking fees? Is the market poised to recover, or are we on the verge of another sharp downward movement? The driver who brought me here from the airport wanted to know, and I confess I was not able to tell him. Still, one can say something about the attitudes of economists and politicians in this matter, and there's nothing stronger in my profession than the desire that things should return to normal and that problems such as we're facing now should disappear. And that desire translates into prediction with extreme ease. And one of the things that I found that was, in a sense, the most insidious about the early phases of this expansion, of this contraction, of this recession, of this depression, was the speed and facility with which so many of my professional colleagues assumed and asserted that it would soon be over, and that we would be in a rapid expansion. And this was not only something that was asserted, it was something that was built into professional forecasts, so that the nonpartisan, as it's always called, Congressional Budget Office in January, before any action had been taken, was projecting that the unemployment rate would return to 4.80% after 4 or 5 years, even if nothing were done. And that optimism, while it's in some sense commendable as a matter of human spirit, has the effect of conditioning the policy response, making it smaller than it would otherwise be, and of shorter duration than it would otherwise be. And if it happens that the forecast is wrong, then the policy accordingly will be inadequate. Still, we are hearing today a somewhat different argument, and it's one that has to be taken a little bit more seriously, because it is not rooted in a kind of phenomenological mysticism, but in a very practical and indeed Keynesian analysis. And the first point to make here is that there are things that are characteristic about downturns, which, however bad they are, tend to limit their duration. The first thing to note is that production always falls more rapidly than consumption does, because people lose their jobs, they lose their incomes, but they don't cut their spending by an equivalent amount. They get some unemployment insurance, they draw down their savings, they don't entirely stop eating. And the result of that, and we are observing this, is that inventories fall very rapidly, and at some point they fall to such a level that people have to start reordering and production starts up again. That is a process which is presently underway and should show some effects in the months ahead. Secondly, when you compare the present economy to the economy of 1929, we find that agriculture is a much, much smaller part than it was then. Manufacturing is also very substantially smaller. Services are very much larger, and services are substantially more stable in a slump than the other two, and so the overall economy isn't going to go down quite as far. Thirdly, and even more important, we have the fact that our government was created in the 1930s and rebuilt in the 1960s, and is very, very much larger than it was then, and still imparts a certain stability to the underlying economy. When people are unemployed, their incomes go, their income taxes also fall, their unemployment insurance, their Social Security benefits kick in to some extent, and this is a process that we call automatic stabilization. It is what gives us, to a very large extent, the enormous fiscal deficits that we're now seeing, which many of my colleagues thought the political system would never tolerate, but which are in fact very large by historical experience and will have some effect. And then finally, there is the fact that in the first weeks of this administration, an expansion package was proposed and enacted, which is about twice as big as anything seen in relation to output in the post-war period. And so some effect will be felt from that. Sounds like a fairly rosy proposition. And it is one which has a certain, shall we say, statistical solidity to it, a certain plausibility, which I don't think we can deny. But at the same time, and here I come to my other hand, we have to be aware that there are substantial reasons to doubt that these mechanisms will be fully effective. The first is that American households remain deeply in debt. In fact, their debts continue to mount in relation to their incomes. And they have evinced a very strong desire to reduce their debts before they increase their consumption. And so even as things may improve, it's at least a reasonable supposition that households will continue to pay their mortgages and their car bills to the extent that they can and to increase their savings to the extent that they can before they go out and engage in a lot of new consumption that would add substantially to the growth of the economy. And there is the fact that the collateral against which households have become accustomed to borrow has collapsed. So even if they wanted to borrow, they would not be presenting the kind of credit profile that banks like to see. And there is the fact that banks themselves have moved from being excessively eager to lend to people with very weak credit to being excessively cautious about lending even to people with quite good credit. And so the whole system on the financial and monetary side is likely to react much less rapidly than has been the case in the past. Secondly, there is a pattern of destruction of capital which occurs in downturns in the kind of economy in which we live, which means, and this will be particularly true as a big industry like the auto industry declines, and is downsized even with or without the bankruptcy of a major producer, such that when an upturn eventually comes, much of that demand will go to imports rather than to domestic production and will therefore leak overseas and will be much less effective in producing a return of growth and employment than might have been the case in the past. And then there is the risk that problems in the financial sector, disasters in the financial sectors are still to unfold, shoes still left to drop. On the domestic side, one hears about credit cards, one hears about insurance companies, one hears about these mysterious things, credit default swaps. And on the international side, one hears about the extraordinary Wild West leverage of the European banks and the deep problems associated with the lending to collapsing economies in Central and Eastern Europe. And it's very hard to know what the effect of a further major financial crisis coming from any of these sources might be. Assuming that it is reasonable to expect a certain improvement, a certain perception of improvement, which may well be felt, may already be being felt in the financial markets, and may well be felt in the months ahead in production and output. What's the nature of the expansion that would occur under that assumption? And the first point to make about it is that this is an expansion which will not be seen as an economic improvement by much of the working population because it will not involve a major increase in improvement in the labor market. It will not involve a return of jobs. We have seen in the last 6 months, a decline in employment on the order of 600,000 jobs a month, and it's clearly still going on. And we don't know how long before it even stops. To reverse that in a year would mean a shift of more than 1.2 million jobs per month, and to say from a decline to a comparable increase. That's not going to happen. However we look at the situation ahead, there are going to be many millions of people who were thrown out of work, who will not find work for a long time that's remotely comparable to what they had, and many of them will not again find a satisfactory job as things are going. Secondly, we're clearly building for an economy that will be based on the same rotten structure of banking that the old economy was built on. That is to say, the administration has taken the policy decision that the banks should be preserved because for some reason they are thought to be systemically important. They certainly are systemically important to the structure of campaign finance. And the result of this, if the program works, and I'm almost more afraid that it will work than that it will fail, is that the big banks will come out of this with an advantage over the smaller banks. The banks that created an unmitigated financial disaster rooted in the greatest financial crime wave in the history of the world will find, by and large, that their position is preserved, and enormous competitive pressure is put on the smaller banks, the more community-oriented banks, more conservatively managed banks, who did not participate in the debacle of subprime mortgage originations and securitization. It's an important point because it raises a question of whether we can apply any standard of law to the financial system. The mortgages, as I'm sure many of you know, were made in many instances to borrowers who couldn't document their incomes, whose credit histories were bad, on the basis of appraisals that were fraudulently inflated, and the payments were set in such a way that they were roughly the maximum that the borrowers could pay for the first 2 or 3 years, and they would explode by a factor of 2 or 3 after that, precipitating a default. And the lenders did not care because they could earn a large fee after 30 days or so by selling the mortgages upstream to an underwriter that would bundle them together with 10,000 other similarly corrupt and fraudulent mortgages, and that these would then be passed on by a rating agency that would sprinkle holy water over some part of the package, declare it AAA, and sell it to the broad public as though it were as good as government debt. That's what happened. And if there is not an accounting for this, then we are leaving the leadership of the financial system in the same hands that brought this on. Thirdly, an expansion built on this foundation is not likely to last because what is most probable, it seems to me, is that resources will go very quickly back into speculative activities, particularly perhaps in the commodity sector, as we saw last summer, and a run-up in the price of basic commodities, and most prominently oil, is going to start setting off inflation alarms, which could cause the whole policy structure to unravel, to be stopped, and the expansion to be halted even before a significant progress has been made on the employment front. And finally, the appearance of good news in the financial markets and in production is likely to bring out the same dreary crowd of deficit hawks who are presently quite quiet, and mercifully so, but who quickly return, calling for cuts in Social Security and Medicare as the cure for whatever problems they imagine can be cured that way. And the consequence could well be a repetition of the 1937-38 experience when Roosevelt tried to balance the budget and precipitated a recession, which was a major check to the progress of the New Deal. What could we do that we are not doing? I'll make 4 quick points and then I'll subside. First, it's clear that we should change the bank plan. It's clear that in an economy where the financial sector was taking 30 to 40% of profits, it was taking too much. Double the share of 15 years ago, and it will have to shrink. The only question is which institutions will take the burden of that. Will it be the small, relatively well-managed ones, or the large ones which are too big to fail, too big to regulate, and therefore too big to manage internally, and for that reason intrinsically dangerous, intrinsically liable to become rogue institutions that will blow up in the face of whatever supervisory structure they're given? To me, this is not a difficult proposition, but then again, I'm not in the pocket of the financial sector. It's clear that we ought to be putting the large institutions into the pass-through receivership, which is the standard way of dealing with troubled or insolvent banks, and working them down so that well-run institutions, which do exist, can take their place in the economy in a world in which effective supervision again becomes possible. Secondly, the unmet human disaster, which is the true story of this crisis, needs to be dealt with effectively. And one of the lessons of the New Deal, by the way, which is lost in the current noisy discussion of whether it worked or it failed, is that the New Deal was not, in the first instance, about restoring production, or even really about restoring employment. What the New Deal did in the first instance was to create a vast interlocking network of social insurance, of protections and institutions for the entire working household population of the United States, beginning with deposit insurance and Social Security, the National Labor Relations Act and the Agricultural Adjustment Administration and even the National Industrial Recovery Act. What the New Deal was about fundamentally was creating the possibility for a middle class to bring itself into existence, to protect people from the worst things that could happen to in the economy. Luckily, a lot of that structure still exists, and we can build on it. We could very sensibly increase Social Security benefits, which would offset some of the losses that the elderly population and the near elderly have incurred and will not recover in the value of their houses and the value of their stock portfolios and in the interest earnings on their cash holdings. A very effective system exists to deal with that problem. It could be used. We could reduce payroll taxes or declare a holiday and give every working family relief from that most regressive burden, which would permit them to make their mortgage and their car payments and to build their savings. And steps of that kind and other steps like reducing the eligibility age for Medicare to 55 as a measure of response to the industrial crisis would help move us toward an adequate social safety net, an adequate system of social insurance, and protect the population from the worst of this disaster. And thirdly, we should remember that the New Deal was not about an effort to restore the economy to the 1929 status quo in 2 years. Roosevelt wasn't interested in rebuilding the 1920s. He was interested in rebuilding the country. And so he didn't speak in terms of stimulus plans. The Public Works Administration was about taking the whole country and putting it on an entirely new track. It built 700,000 miles of roads, 1,000 rural 1,000 airfields, practically every rural school in the country. It electrified the countryside. It built the Chicago waterfront and the Triborough Bridge and the Lincoln Tunnel and the couple of aircraft carriers that helped win the Second World War. This was a long-term construction project. And we have neglected that part of our national agenda for the last generation. We have not had the institutions that could finance the infrastructure projects that state and local governments have been neglecting since the property tax limitations here in California and the New York City financial crisis in the middle 1970s. And we need to do that. We need to rebuild that so that we can meet, in particular, our challenges of energy security and climate change. And if we don't do that, as I say, we're very unlikely to succeed in the long run. And then finally, we should remember that in this country we are in fact governable when we put our minds to it. And the reason we are is that Franklin Roosevelt and Lyndon Johnson gave us reasonably effective structures of government in a wide range of areas, and we can use them. Congress can make decisions and things happen. That is, in fact, in part what is happening now and why our situation is got some elements of hope to it. It's true also of the Federal Reserve. But this is not true in much of the rest of the world. It's not true in Europe, which built a jerry-rigged system on the basis of the economic ideas of the 1970s, free markets and decentralization, and does not have the kind of smoothly functioning policy mechanisms that we've got. And outside the Europe and the United States. It's not true anywhere else either, where the rest of the world is subject to all kinds of instability that we can protect ourselves from. So we ought to be prepared for the possibility that worse can happen, that the rest of the world could present us with new difficulties, and we ought to prepare ourselves to deal with them if they happen. Thanks very much.
Well, thank you, Dr. Galbraith. And let me ask an economist a political question. You've made a very good case. In fact, you even suggested that maybe the Geithner plan, it'd be better if the Geithner plan didn't work. So let's assume, and we know that President Obama is a very bright fellow, and I assume he's heard arguments like yours from some quarters, because he does, not like George W. Bush, who only had a narrow group of people feeding him information. I think he gets a broader palette of information. So what is preventing him from doing the right thing vis-a-vis the banks? Because you notice the audience applauded when you suggested that they should do it the old-fashioned way, which is go into bankruptcy.
Well, I don't know to what extent the White House is debating these issues fully. I think there is that the economic team is quite single-minded, actually, on the question of the financial sector. You hear the same misleading metaphor, the idea that the problem here is one of a blockage in the flow of credit. Right? Yeah. Think about that. The idea is this is a plumbing problem, right? And that credit is something that moves by gravity from the banks up there to the rest of us down here. As a description, I don't know whether this is just simplifying things for an imaginary public, or the way the advisors and the president, for that matter, think about it, but it's completely misleading. Credit isn't a flow, it's a contract. It requires a borrower as well as a lender, and the borrower has to be someone who has something that they want to do, some reason to borrow, and some collateral, usually a house in the case of a household, that is not already underwater on its existing debt. And of course, that situation is badly deteriorated compared to a couple of years ago. So even if banks were stuffed with money, credit is not going to revive on that grounds. The way you have to do it is to, first of all, you don't want the credit system to be leading this expansion. You want job creation and public investment to be leading this expansion, because that's where the priorities actually are. But to the extent that you get a recovery of credit eventually, it will be built upon dealing with the housing problem, dealing with the foreclosure crisis, dealing with the debt situation of households, and getting people back onto a stable financial foundation. And if you do that, then the credit problem will go away. But as I say, is anybody making that argument that's being heard inside the White House? I don't see any evidence for it.
So that leads you to speculate then, is it
I don't speculate. I'm
well,
very careful.
let me speculate,
I'm
and
speculation.
then I'll speculate, and you can shoot me down. Is it a case of campaign finance? Is it that simple? I mean, I suggested in my bomb-throwing introduction that we have a Pecora-style investigation, because it's clear that massive fraud has taken place.
Well, I see that the Speaker, Nancy Pelosi, has actually called for that investigation. A Pecora investigation has a very particular character. It would require the Congress to choose somebody that they trust and give them the authority to lead a completely independent investigation. That was Ferdinand Pecora. There was not one where there was a Democratic and a Republican investigator. There was a single investigator who had a lot of authority. I think that would be a very useful thing to do. But I think there are also ways, actually simpler, more direct ways to get at essential pieces of this question. One is in the bank plan. There is the assumption that when the economy recovers, the assets, or many of them, will recover value. So there's a tendency to treat them, in other words, as an economic investment. And the question is that really reasonable? The way to find out is to ask the Government Accountability Office, the GAO, or the FDIC, to do a study of a reasonable sample of the documentation underlying those mortgages, subprime securities. I think when you did that, and there's been a little evidence on this, you would find that they're overwhelmingly infected with missing documentation, misrepresentation, and outright fraud. And therefore, no independent investor would be able, as a fiduciary, to say, look, I think it's reasonable to put your money in these instruments. They're very likely to default because we can't say anything about what the quality of the documents actually is. Insisting on that would, I think, cause this structure, the assumptions of these public-private partnerships, to unravel. And basically, the only reason you would buy such an asset would be if you were a bank unloading it on your brother-in-law, who was prepared to take a 7.5% loss on the dollar on an asset which you knew was going to default back to the FDIC on a non-recourse basis.
That's the greater fool theory, is it?
No, it's really an inside deal. I say an independent investor would not take the loss that you knew was coming. But someone who was not independent might, because it's less than the loss that the bank would otherwise have to record on its books. And I think that is a very simple way, very straightforward way to get at the heart of the matter and put policy on a different course. I did notice that today, there's a Bloomberg story, that the Treasury is actually had an aha moment, and the stress tests that the banks are being subjected to, it is said, are now focusing on loan quality as opposed to just the relationship between economic events and the supposed value of these assets. If this is true, then we could possibly be moving toward a really fundamental change of direction in this policy. That would be a very good thing and should be encouraged. Is this process, should we assume that the process is intrinsically corrupt? I think everybody's entitled to their own suspicions. But my view is that the naivete and innocence of the professional economist is not a force to be underestimated. And so it's quite possible that we're dealing with just an aversion to facing the reality, which is that the process that got us into this was a process of massive fraud and criminality, which was deliberately overlooked and indeed encouraged by the previous administration.
Well, we had a Hammer Forum about 6 months or a year ago with Michael Greenberger, and he suggested that there's a crisis in American capitalism, that we don't produce anything anymore, people sit in front of computer terminals and make bets, and we've created this kind of casino economy. From what I got from your talk was that perhaps it's not, the financial sector doesn't necessarily have a stranglehold on us, and is there a way then to rebuild the economy, which I think you were inferring there, with or without them?
Yeah, sure there is.
Could you give us a brief?
I have a lot of respect for Mike Greenberger, who was one of the first to see what was going on in the commodity markets last spring and summer, and called attention to
the oil particularly.
And oil in particular. And this is extremely important because it helped break the speculative movement, because it alerted people to the fact that the CFTC, the Commodities Futures Trading Commission, was not doing its job. But on the broader question of the value of the American economy, I think there are lots of useful and important things that Americans continue to do and can continue to provide to the world economy that are in fact useful to the world economy. And I also think that we have major tasks in front of us because we are the world's worst offender, at least on a per capita basis, on greenhouse gases. And we have to reconstruct the way in which we consume energy and the way in which we produce it. There's a major design, a major investment job to be done. And that is a job which could keep millions of Americans employed for a generation. It has to be done over, it's not something you can do in 3 or 4 years. It's not like winning World War II. It's something that has to be sustained over 20 or 30 years or it won't work. And if it doesn't work, well, ultimately sea levels are going to rise. So we're going to have leaving very, very serious problems for grandchildren and great-grandchildren. And can we do this? If we chose to do it and set ourselves the task of doing it, yes, I think we could do it. I don't think there's anything intrinsically impaired about the ingenuity or capacity of the American population.
Well, tomorrow, apparently, the IMF comes out with its annual global report. And according to the BBC, they're saying that the banking system globally requires another $4 trillion. They don't seem to think that the Geithner public-private plan is going to work. And if it doesn't work, then more money will be required and the agony will be stretched out longer.
Gosh, I'm glad you're following the IMF's report. So I don't have to. The IMF is an institution, well, it has been given $1 trillion worth of new life by the G20, but
That's supposed to go to the Eastern Europe, isn't it?
well, one hope so, but it's an institution which deeply discredited itself by, first of all, in the Asian crisis in 1997, and in Latin America, and by and large, the sensible governments of the world, to the extent that they could avoid it, stopped doing business with it. And so until this crisis, it was practically useless. Even the new managing director said it was just a factory for paper. Should we put $4 trillion into the banks? Why don't we have an accounting to begin with of what's in the banks already and what that stuff is worth? There's the concept of a mulligan is a useful concept, but it can be taken too far. In the case of the major banks, there are losses. Let's recognize that these assets are impaired. They're not going to come back. The question is, where are they going to fall? Are they going to fall on institutions which, as I said earlier, should be downsized anyway, which are too big to manage? Edward Liddy, who runs AIG, was put there by Henry Paulson when he came in, he said, the first thing we recognized was that this corporation was too big to manage as a going concern. That's a very sensible thing to say. It's got to be true of other financial institutions that we could name. If you start crediting the losses accurately, then you're forced to the sensible policy, which is for Sheila Bair and her team of Federal Deposit Insurance Corporation regulators to take over the bank, to replace the management. Why do you want to replace the management? It's not a punitive measure. The punishment you leave to the Department of Justice. The replacement of the management is so that the people who are running the bank are cooperating with the regulators and are not continuing to perpetuate and to cover up whatever accounting fraud and other malfeasance has occurred, so that you can get, finally, a clean audit. And then the FDIC prepares that bank for restructuring or sale or merger or closure. And you put in insurance so that the depositors are not panicked. The bank continues to operate, continues to serve its basic infrastructure function, and you wind it down slowly and intelligently. Rather than saying to other banks, you've got to pay a higher insurance fee, and you're going to be pressed to the wall, and maybe these big banks which have been recapitalized will gobble you up. That doesn't make any sense at all as banking policy.
Well, in fact, when you say that IAG is too big, I mean, what's happened is that the big guys have gotten bigger. They've gotten rid of some of their competitors, like Lehman Brothers and Bear Stearns, and the Goldman alumni are bigger and fatter than ever, it seems.
Yes, it does.
So you mentioned a couple of shoes that might drop, the credit card and I guess variable mortgages is another shoe. But the one in Eastern Europe, has a lot of people are sort of zeroing in on that. You also mentioned that the Europeans don't have a central economic kind of controlling mechanism like we have here in the United States. And given that the West European banks have loaned so much to the former Warsaw Pact countries, in particular the Baltic states, who are not in the Eurozone, but they've borrowed in euros, they seem to have little to no economies left. The theory is that there's going to be another kind of cascading ripple on the Western European banks that then will echo back here.
I'm very worried about it. What you have is a process where Western European and British banks borrowed in dollars at low interest rates, and lent on to outside the Eurozone, to the East European, Central European countries, at much higher interest rates. And that was fine so long as capital was flowing in and those currencies were rising. And so you had a great many mortgages that were made in Hungary that were payable that were indexed to the euro or the Swiss franc, the British pound, but were going to be paid in incomes that were earned in forint, or in Croatia, in kuna, whatever it was. And with those currencies now falling, you've got essentially a massive subprime zone. And the losses, and they won't, these are not, they don't have the element of retail level fraud that the subprime securities had in the United States. But the losses will be substantial, and the problem is that the banks incurring those losses are very highly leveraged.
So, they also they got stuck with some of this subprime toxic stuff
and
too.
they're stuck, of course, with that paper as well. So it is a problem which is being confronted by a system of governance, a European central bank that does not have the same flexible charter that the Federal Reserve has, does not have the same flexible people in charge, so far as I can tell, and that a system of national governments which do not have the same capacity to borrow and spend. And so maybe they'll muddle through, but the risk that they won't is substantial and worrisome. I think that's the best way to put it.
And the other thing you mentioned was these ballooning and enormous deficits. The Anderson forecast here at UCLA said that we've already lost $9 trillion from the stock market and $5.5 trillion from the housing market. And I'm just wondering, at what point would you suggest that we pass to sort of, is there a red line out there?
That's not the thing I worry about. One of the things that I think is a positive sign now is that we have allowed the deficits, basically the automatic stabilizers, let's call them, to work. And we are going to see a benefit from that. We're going to see the benefit from lower tax revenues and increased spending, and the stimulus package on top of that.
That's what's called Keynesianism.
It is a Keynesian point. And one of the things that some of my colleagues, whose judgments I trust and like, and there are a few,
I think there's some of them here, actually.
were worried about was that the political system wouldn't tolerate the kind of fiscal shift in the fiscal position on that scale. But the political system seems so far to be putting up with it quite well. And maybe just fear and necessity has played their role, and nobody's going to complain if there is, in fact, a benefit from that. So the last thing I would like people to do is to scare themselves because the government's budget numbers look very large, or because the Federal Reserve's balance sheet looks very large. If the concept of $2 or $3 trillion is frightening to you, you should be in some other field, because we're now working with that range. The Federal Reserve nationalized the commercial paper market, took a couple of $1 trillion onto its balance sheet. This was exactly the right thing to do, and if they hadn't done it, those trillions would still be there, but there would be business losses and bankruptcies and things of that nature.
So the old adage in Washington that a billion here, a billion there, sooner or later it adds up to real money. Now it's a trillion here, a trillion there, sooner or later it adds up to real money.
I'm not even sure it does, yeah. The concept of real money here is, I think, what's obsolete.
I see. Well, we have some inquiring minds out here in the audience who want to know. We have 2 microphones on both sides, and there's a microphone up there. The lady with a hand up in the...
And please wait for the microphones because we're recording this event.
I have a 2-part question for you. Assuming that the Federal Reserve is a collection of, say, a dozen private banks, there's a libertarian movement to end the Fed, and I'm wondering, if it were, is it truly dangerous to do that?
Yes, it would be very dangerous to get rid of the Federal Reserve at this moment.
And why?
Because the Federal Reserve provides the capacity to lend to the financial system in a way that no other institution would. The regional banks, you could get rid of all of them. Nobody would notice. They're totally unimportant. The only thing that matters in this system is the Board of Governors in Washington, and that is unquestionably a public body. If you want to check that proposition, I will point out to you that the Federal Reserve Board does not pay property taxes in the District of Columbia, and the idea that they should pay property taxes quickly caused them to confirm that they were in fact an agency of the United States government.
Microphone on this side. This gentleman here in the second row.
It seems to me that one of the more underreported stories has been the role of the rating agencies, Moody's and Standard & Poor's, especially in regard to AIG's meltdown. Can you comment on whether that's been properly addressed or if it's just being essentially swept under the carpet?
The ratings agencies, which issued in many cases AAA ratings on these over-collateralized bundles of subprime securities, were in effect committing fraud because they were not looking at the quality of the loan. They were basically making that judgment based on a model, properties of the model totally obscure, and they were doing it under pressure, that is to say from senior management, because the agencies, the underwriters were able to shop for a rating, and the agencies would not be paid unless they issued one. That is a system which is intrinsically corrupt. I would suggest that the credibility of the ratings agencies is one of the casualties of this system, and I cannot imagine that they will recover that credibility for independent investors anytime soon. So that does suggest to me that we need, first of all, a thorough, this needs to be included in the investigations that are sure to come, and that we may well need a replacement structure for evaluating these private securities, because this is just, you can't have a financial system if you don't have something performing that function. But it's clear that the copybook of the existing agencies is very, very badly blotted by this experience.
This lady in front here.
Is the condition of our economy a negative incentive to our pulling the troops out of both Iraq and Afghanistan?
That's a question that's above my pay grade, but I have to say I don't think so. I don't see why it should be, and the amount of employment that's being given to soldiers in Iraq and Afghanistan is very minor compared to the scale.
Well, what if you add
We lose
to
6
that
times
the
as many jobs
contract-
every month as we have soldiers in Iraq.
What if you add to that the contractors that are employed in those countries?
Lots of cash, but still not that many employees. We're talking tens of thousands, whereas the scale of the economy is millions, and millions of jobs lost. So I would say it's just, these are separate issues from my point of view.
Thank you.
Yes, this gentleman in the middle here.
A pretty good argument can be made that over the past maybe 40 years, or at least since the end of the Second World War, the defense system, as it's called, or the military system, has been a form of Keynesianism for the U.S. economy. That it's been a form of subsidy for a lot of high-tech development. So if we're going to transition to a Green New Deal, something that addresses climate change, it seems like the single largest portion of the federal discretionary budget, which is the military system, could be a big part of that. What's your opinion on that? Do you see that system as being reformable, or should the money just come from somewhere else or go somewhere else?
Well, this is an issue I've been very much concerned with over the years. I chair the board of an organization of economists that focuses on this issue. It's called Economists for Peace and Security, and I highly recommend to you to take a look at that, at the work that we've been doing.
How would they do that?
www.epsusa.org. It's clear that the military budget per se has had a significant influence on the development of our economy in two respects. One is the spending, and the other is the kind of technological direction that we've taken by putting so much of our research and development dollars into technologies that have connection to military activity. It's affected us in our transportation system, the heavy reliance on aircraft, in the communications and space economy, and in information technology, just to name three. And I think it is clear that we need to have functioning institutions that are independent of that influence in order to deal effectively with our energy security and climate change issues. And the reason we do is that that these issues are just deeply involved with the domestic structure of our economy, things that are precisely neglected when we put our resources into the control and stabilization of the world energy supply system. So not to say that the two are mutually exclusive, but that one very important task tends to be neglected, and it should not be neglected any longer. So that would be, I think, the major thrust of my argument. I would, on that issue, I think on the whole, in the share of the military in total spending has declined quite a lot since the 1950s, actually, and the share of the civilian sector has grown very much. So that in terms of being able to stabilize our, the consumption spending in households and the business investment spending, it's not as significant a factor as it was 50 years ago.
Isn't it true that it's the healthcare is the biggest?
Healthcare is substantially larger. The military spending is 5% of GDP. Healthcare is 15 or 16. So that just in terms of the scale of things.
And it's the most expensive, covering the least number of people of all the countries in the world.
Oh, sure. The healthcare system
presumably there's some room to improve it.
Yeah, the healthcare system, obviously, the problem with our healthcare system is private medical insurance. I think we have wonderful doctors and hospitals, but the access to them is uneven, and payment for their services is just a nightmare, and a completely avoidable nightmare which exists for political reasons, nothing else.
The gentleman in the second row from the back.
Thank you. Dr. Galbraith, is the Fed printing trillions every few months in essence to ultimately fight the inertia of a potentially avalanching $500 trillion plus derivatives marketplace globally? And relatedly, this is related to your Washington Monthly piece, which I just finished this week. How will the federal government be able to spend on all of the projects you propose in said piece should petrodollar recycling and foreign treasury bond buying cease and a dollar crisis ensue?
Okay, the first question is, should we be concerned about all of this activity by the Federal Reserve? I mean, the thing to remember here is that there is public money and there is money created by the banking system. And that element, the privately created money, has been what has been imploding in this crisis. People are repaying their debts, not taking out new ones. And what the Federal Reserve is doing is trying to ensure that that process is limited to the extent it can be. It's trying to go around the banking system to create, in some sense, a new parallel system so that businesses can get access to the commercial paper market, just for example. Commercial paper is very important, it's very large. So I don't think one should be worried about the Federal Reserve's action unless you take it in the context of the very large declines that are occurring in the private financial sector. The second part of your question is, how do we get the government, how do we mobilize the resources? My first answer to that is we have something that the Roosevelt administration did not have in the early 1930s, and that is very much larger state and local governments. And the first place to put the resources is into preserving and even expanding state and local public services. Perhaps the worst and most avoidable thing about this crisis has been the extent to which it forces state governments, because they are constrained by balanced budget requirements, to cut back on essential public services, on schools, on fire, on police, on transportation, the raising fares on mass transit, when what we should be doing is cutting them to zero. Every kind of perverse incentive operates, and the right thing for the federal government to do is to make essentially unlimited resources available to the state and local sector, both for their operating budgets and to expand the capital investment projects that they've been putting off for such a long time. So the construction industry's resources are there. And so I think that is a very good place to begin and gives you really considerable capacity. Then on top of that, on some areas, and in particular in energy, I think the federal government just has to come and invent some new things and get some capacity to put together systems that work at the national level. And that's something, of course, that does take a little more time and a little more ingenuity.
The question I mentioned, recycling petrodollars, I recently spoke with Joe Stiglitz, who's called for a new international reserve currency and seems to think that it's doable and it may be done.
Now that part of the question I didn't address. One aspect of this crisis, which I think caught a lot of people by surprise, is the extent to which the rest of the world is more fragile than we are. And as a result, banks try to get rid of their dollar liabilities, hold on to their dollar assets, and the dollar went up rather than down. And this was not good news, because it meant that in addition to everything else, our export sector is going to get clobbered. But it does indicate that the position of the dollar atop the pyramid of world finance is not the first thing that's going to topple. And I don't think it's going to topple, even though the Chinese government has gotten some pleasure out of saying that they're worried about the extent of their dollar holdings and this and that. They may be worried about it, but that's not the same thing as saying that they're prepared to kick over that apple cart. They're not. So should we proceed on the assumption that if we're doing useful things, the world will finance it? Yes, we should.
Question there, right next to you there.
Dr. Galbraith, back in the 1970s, the United States was the greatest creditor nation in the world, and now we're
Do you
the
say
greatest.
creditor or predator?
Oh, maybe both. Now we're the largest debtor nation in the world, and we used to have a strong industrial base, and that has been eroded by cheap imports and exporting jobs. Are you in favor of bringing back our industry so we can put people back to work, or is that impractical at this point?
You know, I'm not opposed to buying shoes and shirts and circuit boards from China. I really am not. And I think if the Chinese decided that they didn't want to sell them, these are factories that could easily be reestablished in the United States. Factories can spring up like mushrooms, factories of that kind. In China, in the last 5 years, they added 5 million jobs in these sectors, mostly supplying the rest of the world, and then they lost a lot of them in the crisis in the last few months. What we should do in this country is two things. We should build an industrial base for the future, not the past, one that takes advantage of the capacity that we have to originate and implement scientific and technological advances. That's something that the Chinese don't have the capacity to do, something that we do in fact have the capacity to do, and we should be doing it in a strategic way and on a very large scale. And secondly, well, three things come to mind. Secondly, we should be rebuilding the public infrastructure of the country that we have neglected, which is a major component of the standard of living of the population, but which we simply have allowed to decay because of what my father called private affluence and public squalor, the emphasis on private as opposed to public forms of consumption. And then thirdly, we should be using our wits, our imaginations, to create jobs that people would like to have, that give them some capacity to do what they would like to do. And I have a job in the arts and entertainment, a job that is in human services, a job that is in elder care. These are extraordinarily important jobs. We should finance them and create them and make sure that everybody who wants one can have one. And that will, at the end of the day, we will live at a higher standard and we will live within the means that the world will permit us to have, I think, if we do those things.
The gentleman waving his hand here.
Yes, really enjoyed your speaking. I wanted to ask you a question regarding, this is just a period, a continuation of a program of consolidation of power, and that in the process of consolidation, there's going to be losses on the small man, because the guys who are the bankers are there's nothing going on with them. So is this, it's just a continuation, like the 30s, you had depression, now you've got this recession, but it's all built on greed and selfishness. And so it's going to be very difficult to change anything, because from the bottom to the top in the banking system, everyone was being, they were, everything was, corrupt, from the real estate broker all the way up to the top. So it's going to be very difficult.
And this gives me an opportunity to hit the theme of my book, which is called The Predator State. What was at the foundation of the crisis was the deliberate subversion of the public responsibility, the government's responsibility to regulate the economic system and particularly the financial system. That was built upon an ideological misunderstanding, deliberate misunderstanding of the proper relationship between the government and the economy. The idea was that there was an opposition, an adversarial relationship, and that you should government regulation had costs, you should minimize it. That was the Reagan idea. The reality is, in a complex society, regulation sets the terms of private activity. If regulation is effective, private activity is can be kept reasonably safe. And that's true of the food chain, whether you're willing to eat the lettuce because you're reasonably confident that it's not contaminated, whether you're willing to buy a toaster because you're reasonably prepared to believe that when you plug it in, it's not going to catch on fire, or a television set, right? And whether you're willing to deal with a bank because you have some assurance that someone, these are obviously intrinsically rapacious institutions, there's got to be a cop on the beat. If you think that the cop is off the beat, then these systems, which are too complicated for any individual consumer to monitor, break down. And I would argue that the fundamental difference between a developed and undeveloped or underdeveloped country is whether there is an efficient and effective regulatory system. It's not technology, which can move very quickly. It's whether there is a trust that permits complex systems to function efficiently. And so the problem you raise, so the breakdown in the trust in government and the ability of government to function with autonomy, is a fundamental problem about the effective functioning of the economy. If we don't address it, we're on a path of decay.
But the people that we're entrusted with.
Gentleman over here in the third row.
Don't you think the finite capacity of the Earth is too challenged by a population of approaching 7 billion human beings for any system that's based upon the idea of growth, indefinite growth, to get us out of this situation?
You know, population is a very serious question, but if you want to deal with the immediate ecological challenges, it's a relatively small part of the total population whose activities you have to change. We're 300 million. Europe's another 300 million, and they have a per capita energy consumption that's half of ours. So the most dramatic changes are actually done, what I call the tails of the distribution, the people who are using the most of the resources, or more seriously, putting most of the contaminants and the greenhouse gases into the atmosphere, rather than the billions who are out there whose needs are not being met at all.
The gentleman behind you there.
Assuming that the political will is there to take over the big banks, does Sheila Bair and the FDIC have enough personnel to do the job?
They're hiring like crazy, and that's a good sign. When you take over the management of a major bank, you don't need to replace everybody. You probably need to bring in a fairly small team, and then you hire bankers, people who actually know the business, and you promote middle managers from within the institution. The important thing here is a command principle. It's not that everybody in the bank was doing a bad job, but you want to have a leadership team which is not committed to the practices of the past. And the other thing you want to do, by the way, is to get rid of people who were grossly overpaid, who were overpaying themselves, and who were in a close mutual back-scratching relationship with the board of directors, which you would also replace. And the reason you want to do that is that at a certain level, the kinds of compensation packages that we've seen really detach the top leadership from the long-term fate of the institution. You want people who are paid like middle managers, well, but not grotesquely, to be running those institutions and figuring out what's best for the institution over the long term.
Right in front of you there.
Thank you. Given the intransigence of the
Sorry, speak up a little bit.
given the intransigence of the high-end 1,000 or so people that brought on this huge crisis and the doubtful quality of the fixes, can you give us an idea of a worst-case scenario of what we might be looking at?
Yes, I could give you a worst-case scenario. I'm not sure you want to hear it. The worst-case scenario is a kind of general panic. And a return to influence of people like Peter G. Peterson. That is to say, those who argue that the real problem in the economy is the dreadful amounts of money that we're lavishing on the elderly by Social Security and the great expense of Medicare. If it turns out that we go through a phase where policy it goes back under the control of that group, then frankly there will be no saving any of us.
You mean the people who can afford to have full-page ads in the New York Times all the time?
A guy who has $1 billion to spend on propagandizing the public, right, and putting out movies, and it's much more than full-page ads in the New York Times, on the proposition that the problem of the country is not the abusive behavior of the financial sector, but rather the deeply excessive generosity to low-income elderly people. If we go down that path, frankly, as I say, the country will not be savable, will not be worth saving.
The gentleman here in front, where's the, there we go. Yeah. Oh, go
Hi.
ahead.
I keep hearing all this talk on the internet about this New World Order. Do you think there is a small group of dominant men who are trying to control society?
Of course. The only question is whether they're succeeding or not.
Do you think they're the ones who are creating this financial collapse?
You know, I think the financial collapse I've given my story, and I'm sticking to it. It was the deliberate removal of the police in the financial sector. This was not a subtle thing. To be very specific, the first director of the Office of Thrift Supervision in the George W. Bush administration came to a press conference on one occasion with a stack of copies of the Federal Register, the Code of Regulations, and a chainsaw. A chainsaw. Right? This is a way you send a distinct message to the professional press about what you're going to do about enforcing underwriting standards. The FBI in 2004 explicitly warned that we were facing an epidemic of mortgage fraud. Nothing was done. When that happens, what you should do is form strike forces and get those agents working in coherent groups in the areas which are most severely affected. Instead, the worst regulators from the savings and loan era were promoted to the point where they were in control of the regions that had institutions in them like Washington Mutual and IndyMac. Right? That's how this process was allowed to get underway, and it had very specific benefits for the administration in power for a period of time, with a very clear and certain unhappy ending that was going to come, and I imagine they thought it was not going to come until after they left office. They got caught in the last 6 months or so in a calamity that was eminently foreseeable.
There's a lady in the back there who's got a cheer squad because they're all pointing at her.
Thank you. Well, in light of your emphasis on regulation, and of course you're right, you know, when we lost the Glass-Steagall Act, it was kind of the last straw, wasn't it? In light of that, does it disturb you that Tim Geithner and Larry Summers have such important jobs in the United States Treasury when they themselves are basically anti-regulation?
Who would it not disturb?
Well, you haven't mentioned Obama or you know, his position, and my question really is, what do you think his position is on this meltdown? Is he for regulation or not?
I think that the administration has taken office and pursued policies on a false supposition, which is that you have to rescue the economy through the existing financial sector and the existing structure in banking. And I think that's going to prove a really big problem for the effectiveness of policy and the stability and trustworthiness of the banking system going forward. And I think that it would have been very sensible to turn to people who had opposed the repeal of Glass-Steagall at the time, rather than those who favored it. That's, you know, there's a very clear set of records here. I'm not saying that Larry Summers can't learn. It's clear that, improbable as that may seem, it's not. It's the case that he can, and he's making a very strong claim that he has learned. But until we see, you know, a really forthright and direct dealing with the calamity in the banking system, I don't think we're going to be able to turn the corner on the restructuring of the financial system. And that's just, that's going to be an albatross around the economy. I don't want to go so far as saying that there won't be improvement, because anytime you're running deficits of 10 or 12% of GDP, you're going to have a very substantial effect. The question here is the direction going to be right, and is it going to be sustainable?
And you mentioned the repeal of the Glass-Steagall Act. In the Senate, there were only 5 Democrats who voted against repealing it, and there was one Republican, Shelby of Alabama. The 5 Democrats, Byron Dorgan, Russ Feingold, Barbara Boxer, Brian of Nevada, Barbara Mikulski. Not too many.
When you go back to that period, the argument was made that Glass-Steagall was already a dead letter. And there's something to be said for that argument. But clearly that action was part of a movement toward financial instability and disaster. Further actions occurred a year later when, in December of 2000, Phil Gramm slipped into the appropriations bill, a bill that created new loopholes in commodity regulation. And then, of course, the turning over of the regulatory structure to the most aggressive and predatory elements of the financial industry in the Bush administration completed the job.
So I wasn't wrong to say the bookends, they started out with Enron and ended up with what happened on Wall Street.
Oh, sure. I don't worry so much about the idea that there is going to be a massive collapse in the value of the dollar, which is everybody repudiating or trying to dump U.S. Treasury bonds. The reality, and that's what the hyperinflation scenario is. The reality is that there is no such thing as a European bond. They're bonds of individual European governments, which people could substitute U.S. Treasuries for, which means that they're going to be accepting the credit of Uncle Berlusconi over that of Uncle Sam. I think that we're not yet at that point.
The lady up there behind you, in the back, waving a hand.
It seems to me that I've
Could you
heard-
speak up a bit? Sorry.
Sorry. It seems to me that I've heard many economists over the past few months agree with Mr. Galbraith, Dr. Galbraith, including ones that are generally more conservative. And I was wondering if there has been an attempt or if anyone has considered something along the lines of the Union of Concerned Scientists, which got together in connection with the last administration's sound science policies. Meaning, are there economists who would like to get together and recommend or provide something contrary to what the Larry Summers and Tim Geithner programs are?
Yes, for sure. We are definitely working on it. I'm taking all advantage of my newfound respectability. A few weeks ago, the Council on Foreign Relations found itself sponsoring a seminar on the New Deal, and it was organized by the redoubtable Amity Shlaes, who is everywhere writing that the New Deal was a disaster that prolonged the Depression. I found myself, to my astonishment, being called to speak at this thing in order to lend a degree of respectability to an event at the Council on Foreign Relations. I mean, it strikes me as the world turned upside down in a nutshell. Paul Solomon of the NewsHour says I've moved to the center more rapidly than anybody in history who hadn't changed his views. And we are taking advantage of it. Again, the organization Economists for Peace and Security that I mentioned earlier is working on just precisely this kind of activity, providing in a nonpartisan way and as broadly based way as possible a kind of coherent framework for thinking about what we should be doing. And it's not oppositional in every respect. I was strongly in favor of the expansion package of the stimulus bill. It was very much the right thing to do and probably the best piece of legislation that you could have gotten through Congress in 3 weeks. And there are all kinds of trade-offs associated with doing that. But I think on the whole, we're much better off having it than not, and it's vastly better than what the Republicans did, or what the Congress did last year to try and stave off the disaster. So we have very big, important differences, and particularly over what's being done with banks and financial markets, but not on all issues.
The gentleman here waving his hand in the front.
Yeah, following up on the last question, there are some who have said that it was only World War II that pulled us out of the last depression, and is that an urban legend or not? And if it is true that it did provide the coherence and shovel readiness of a major program with enough bodies to go to work, is there a moral equivalent to that war that you can see realistically being brought to bear now?
Two very important questions. The New Deal has been the subject of an enormous amount of nonsense in recent months. And part of that nonsense is based upon a misreading of the statistics, and particularly of the unemployment statistics, which were created after the fact. They weren't there in the 1930s, and in which the idea of the economists who created them was that they were interested in the recovery of the private sector, not in how many people actually had jobs. So they didn't count. They deliberately excluded the millions of people, 3.5 million or so, who were actually working for the New Deal in temporary jobs, and counted them as though they were unemployed. Well, they weren't unemployed. They were building the Lincoln Tunnel and the Triborough Bridge. They were paving roads all across the country. They were getting up in the morning, working, and getting paid for it. The difference is that when you count them in, you find that unemployment between 1933 and 1936 came down from 25% to less than 10. A very, very remarkable and rapid recovery, the most rapid rate of growth in peacetime history. And then it went up again in 37 because Roosevelt tried to balance the budget, and it came back down again in 38, 39 before the war. So from the standpoint of unemployment, you can argue that the New Deal, in fact, ended the Depression and did a huge amount of national construction before the war. When the war happened, the unemployment rate went the west of the way to zero, and that's another story. But it's, obviously, the 9% is not a great rate of unemployment, but compared to 25, it's, very much out of the woods. The other piece that's important, though, is to ask what happened in the war. One of the things that happened in the war was that incomes went up about twice as fast as consumption. Why? Because there was a huge amount of production for the military to support the war effort, for which people were paid, but no corresponding increase in the production of goods that they could buy and eat. So something had to be done with the incomes. What was done with the incomes was that they were socked into victory bonds, into Series E bonds, which gave the American population something it had never had before, a vast amount of financial saving. Right? And I think you can argue that it wasn't, that the contribution of the war was to make possible the recovery of the financial sector in the 1950s, because people were suddenly creditworthy again, which they had not been in the 30s and were in the 40s. And so the point being that Roosevelt did not try in the New Deal to revive the banking institutions that had given us the 1920s. He didn't try. They were there, the ones that survived carried on, but they were a very minor piece of the picture. It was a public sector that stepped in and did the job, and then the war that rebuilt household finances, and only afterwards did you get banking to recover. And I think that's a very important lesson. If you come out of a banking crisis and try to revive the banks, good luck. It's not going to revive the economy, and it's not the way to proceed. Hoover tried it, but it didn't work for him, and it won't work now if that's the way we're going to go.
Well, of course, there's no logic when conservatives and libertarians try to dismiss and trash the New Deal and government spending, and when they make the argument that only World War II got us out of the Depression. Well, what was World War II but government spending? I mean, it's an illogical argument, isn't it?
Yes, but the prior point is that it's contrary to fact. Mm-hmm. It is based upon the idea that people who are working for the New Deal weren't really working, and that's just, that's a historical fiction.
Well, we'll keep it down to two more, I think. Then we get in front here.
Thanks very much. I have a question about the credit default swaps and the questioning of AIG on who they actually disbursed a lot of the billions of dollars that they got from the government to, and their refusal to answer. And then I think there was a protocol in Europe, or a program about credit default swaps, where people were signing up to make it somewhat more transparent, and AIG declined to participate in that too. And it's just been a huge question mark for me. Can you say anything about that?
Well, I don't know anything that isn't generally known. We do know that a large part of what went to AIG went to its counterparties, who were firms that it was exposed to, and that, so we can say Goldman Sachs did quite well out of that. We know that for a fact. The larger question of, but also a lot of European banks were also on that list.
UBS.
Yeah, sure.
Phil Graham's bank.
Sure. I have to say, last summer I was called by a couple of very brave management interns, presidential interns at UBS. And they had been assigned to give a presentation to the board. These were college kids. On the theme, Barack Obama will be a better president than John McCain for the economy and the financial sector. Could I give them some advice on? I said, sure. What you must say is that the one thing we know for certain is that in the administration of President Obama, former Senator Phil Graham will have no influence at all. Back to the credit default swaps issue. This again was Graham. This was part of what the Commodity Futures Modernization Act that he slipped into that bill in December of 2000 legitimated. A new industry, which was basically the idea that you could have insurance policies without reserves. And the thought that Rubin and Greenspan and others had was that everybody would offset their exposure so that everything would net out. What in fact happened was that you got an interlocking transfer of risk around the system in ways that nobody could tell because all of these are private contracts with no transparency. There is no earthly reason why we need credit default swaps. We didn't have them. The economy functioned perfectly well for several centuries of modern capitalism before this thing was invented. It is a form of gambling that is basically conducted by financial institutions without regulation or limits, and it should be eliminated. It's clearly an intrinsically unsafe practice because it makes risk exposures difficult to impossible to track. And the idea that you should be somehow making the market for this work better strikes me as a real misconception, and something that a sophisticated person shouldn't think. You can't make, the only way you can make the market for this work is to have a standard set of instruments which are traded and which are subject to rules, and those then are not credit default swaps. Those are called insurance policies or something. A very similar argument on subprime securities. The point of policy should not be to try to revive the markets for these things. The point of the policy should be to suppress the instruments because they are intrinsically unsafe, intrinsically not something, a private loan of this kind and of that quality is intrinsically something that cannot be securitized safely.
The gentleman here in front,
I should introduce him. This is Michael Intriligator, a distinguished economist, econometrician, and a vice chairman of Economists for Peace and Security.
I work with Jamie at EPS. Since Larry Summers' name has come up several times, I'd like to tell a story about Larry Summers I think people will find amusing. During the East Asian financial crisis, which began in Thailand with the devaluation of the Thai currency in 1997, I happened to be in Bangkok at that time, and Larry Summers came through and gave a speech about how to deal with their crisis. What he told the people there is, you got to set your accounts in order, you got to raise your taxes, lower your spending, get your international accounts in order. And the local people said, would he say the same thing if that happened in his country? Well, we see exactly the opposite of what he's saying now. As the main advisor to the president, as the chairman of this newly founded National Economic Council, he's giving exactly the opposite advice than what he gave the Thais back in 1997.
Well, that just shows that there is hope and learning is possible.
Well, thank you so much for coming here.